penny stocks are dangerous. There's a reason this is on the docket, because one of my friends I played tennis with mentioned that she lost some money in penny stocks recently, I think. And then she was distraught because like she got wiped out. I don't know the details. And then like the penny stock went on to like double or triple. And she's like, oh, I've missed out on these gains. Like, this is just not an area you want to be investing in, right? Full stop. It's very hard to argue, right? In an incredibly special situation. Welcome to the Wall Street Wildlife Podcast with Luke and Christoph. On today's episode, Christoph is going to tell us about his favorite stocks with 10x potential. Hang out for that one. We are going to chat about the dangers of penny stocks. Maybe one of Christoph's 10x's is a penny stock. Let's find out. I am going to review my Rocket Lab position, which is literally going to the moon, and I'm going to sweat the gains. And Christoph is going to hopefully reassure me to stick with the plan. And Christoph has a very special Phoenix or Dodo situation for us with a stock that's doing the opposite of Rocket Lab and potentially going to zero. Fun podcast.
Most importantly, from the bottom of our hearts, thank you to all our current Patreons. Your generosity in joining our Wall Street Wildlife Jungle Tribe is really helping us make the show better. We're hiring editors and we're starting to like get really fancy on y'all. The show's just going to keep getting better. So thank you so much for your support. To join one of the animal tiers, go to patreon.com/Wall Street Wildlife, all one word, and then find your inner animal beastie. This week we gained, oh my goodness, we have a Lance P in the tribe. We have a Ruben W, a Hatem, forgive me if I butchered that, Hatem Y, Colby, and Lorenz M. Gentlemen, thank you so much. I'm wearing a special slothy Wolverine shirt in your honor. And it really does. Let me just say this, that the sloth tier is only $3. It's the tip jar, but you know that chunk of change adds up. So if you're still on the, free tier and you're like, $3 ain't worth it for these goofballs. I'm saying it is to us. So, slothy pride to all you new sloths.
I'm opening like a short conversation in the DMs on the Patreon when someone joins. And like the thing that is most meaningful to me personally is like there's someone out there listening to our shit. Well, every week we record. I used to spend a day doing the editing. Like, thankfully, we have now outsourced that. And but there's really someone there listening to our shtick. So awesome.
Yeah, that's the whole point of why we're doing this. So it feels good. And then, it's a virtuous circle because the more people that learn about us and about each other, the community builds and it just gets better. So thank you all, Patreon animals.
I would like to raise a glass. Actually, Monday is always my fasting day. So I have like 0 calories on a Monday, but I shall be opening a glass of this tomorrow. If you're not on the YouTubes, I have a beautiful bottle of Kochi Vermouth, which a kind monkey sent me by post this week because I won a bet. What did I win?
Yeah, it wasn't out of kindness. You furry clawed. you who takes advantage of vulnerable, gentle creatures. I lost a bet to Badger. His closing price post NVIDIA earnings of it was 145, right? Was very close. I think NVIDIA closed at 144.67 if the memory bin serves, or somewhere around there. I thought it was going to do another one of those 10% exceeding expectations, but that did not happen. So in regard to the earnings themselves, I think the most important thing I heard was not only did they meet and beat expectations, because that's a given and the market already assumes that would be the case, but it's like, what does the future look like? And NVIDIA's coming out with the, I think of it as the even fancier toys, and they're seeing that demand is not going to be an issue whatsoever, that it's all supply constrained. And when you have that situation, that means the revenue and the margins are going to get either stay the same or get even better. and that the whole AI train is like full steam ahead, and NVIDIA is the backbone of it. So the market had every reason to keep the shares as lofty as they were, and no reason to sell.
It's interesting, isn't it? And it's a great reminder that valuation is such an important part of an investing framework if you want to be effective in the long run. Because, like, by all accounts, NVIDIA have put in yet another incredible set of results, blew market expectations out of the water. Like, there's so much demand for their product, but actually the stock price stalled. It didn't really go anywhere. And it's because there is so much growth and anticipation built into today's valuation. Like, is it a value trap? Am I using that term in the right way? Or there's some other term for it where something is just, oh, that's the wrong term. What's the right term?
Well, no, that's good. Value trap is the opposite.
Okay. Right.
It's in this case, something like CHRS could have been a value trap because people are like, oh, it's so cheap. So you pile into a bad company, but it only gets cheaper.
Right.
Not the situation with CHRS, but that would be the more appropriate label.
All right. There we go. Thank you for educating us. But nonetheless, this is an expensive stock. And even when it kills it, the company might do brilliantly, which it is. The stock at today's valuation might stall, might trade sideways, might heavily dump off. So this is the risks and perils of investing in highly valued companies.
Right. NVIDIA, though, is such a special case because it's the company that's kind of reinventing the world at the moment.
Yeah, like it is until it isn't, right? Yep.
I mean, you and I sold out because of valuation reasons, and we were wrong to do so, but that's because we have a lot of experience when everything is rocket ship to the moon until it ain't, like you said.
Yeah.
But again, I'll just say every so often you get a Google or you get an Amazon or you get an NVIDIA upon which the entire world depends. So,
right on. All right. Well, maybe you're going to tell us about a company in this next segment that we'll be having that same conversation about in 5 or 10 years' time, because you've got a bunch of 10x investments for our listeners.
Well, so I want to cue this up with maybe a longer-winded setup.
All right.
You whooped my ass something silly in year one because you invested in companies already performing well, and then they just kept performing or exceeding expectations, and then the market got very excited about the shift in interest rates. And now with the new administration coming in, the market's continuing to be very frothy. So you whooped me sort of fair and square in terms of the strategy we both know and love, just executing. I did not, I'll say, long-time listeners, forgive the repetition, but this needs to be said, I think, again. I did not intend to have the portfolio that I have because it's so far different from what I've usually done. However, over the past year, it's kind of amazing to me what I've ended up with. And it was just this weekend where, I was looking at our results and, thinking things through, that a light bulb went off my head. And it's that without exception, with only one asterisk, all of my holdings are, I think, legitimate 10x potential companies. And that means that the gap between what I see in terms of the fundamentals and the potential worth is so wide that the market hasn't yet caught on to this, or not enough time has yet passed, that they're all sort of like coiled springs. And the amount of time it might take to get to the 10x if you're a Patreon, I made a very fancy spreadsheet with a whole column, lots of pretty colors that said my estimated time, best case scenario in which we might see the 10x. And some of these are as little as 2 years. So I think what I'm trying to say here is it was a surprise to me that I could legitimately categorize all of these as potential 10xers. I also included a column with my completely out of the ass probabilities. Like, what do I really think like what the odds are. I bet you're gonna squeeze my shoes and paws about this column. But I was like, I was really trying to be honest. Like how's this look? Like, am I really just indulging in a whole bunch of hopium?
Yeah.
And so we could talk about those. We could talk about those. You hold on. You'll have your turn. And one more point I want to say. 2 more points. It's not that I don't think your stocks, Luke, can't also 10x. So that's also a sort of weird gray area, because if your companies keep executing, like Rocket Lab, for example, which we'll talk about, right? Which could have easily been one of mine, though I screwed up with the options. Won't get into that again. But this does lead me to a big principled idea, which is the market efficient or not? And all investors always squabble over this, right? And the only way this current King of the Jungle portfolio makes sense for me to say these are potentially 10x in as little as 2 years is if the market is inefficient.
Right.
And I truly fundamentally believe that. And I believe that because I've invested for 25 years. So all the cases that have come up over and over and over and over again, where there are some situations where despite all the information, despite all the price data, despite all the quants and blah, 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 there's still a fundamental mispricing in the equities if you have done your due diligence and you kind of understand what the ground is relative to what the more arbitrary price is. Okay. So I saw on our Patreon that after I posted my portfolio, we got the big old badger does not approve of monkey shenanigans report. So have at it, buddy.
All right. And we'll put something on screen here and we'll just list out your companies. Are you happy for us to share like all of your columns? Because a couple of them are interesting, right? You've got the stock name, you've got is a 10x possible, and then you've got your odds of 10x and the minimum time to making a 10x. Can we stick those on the podcast, or is that for Patreon members?
You know what? At this point, it's okay. Let's share with everybody. Okay. Patreons, you guys will bless you with all kinds of good stuff in the future.
All right. So here it is. Here's the list: CHRS EOSE, Relay Therapeutics, Iris, Tesla, ASTS, Space Mobile, and Chainlink. There's your 6. Now, I haven't actually got any major problem with any of these 6, particularly Tesla, which I own. And I think they're interesting opportunities. And I've got like a venture sub portfolio in my portfolio, and I call my options like my gambling side. That's really kind of like my venture investments. It's the stuff that I think like 9 out of 10 of my venture investments are going to fail. They're going to trade sideways. They might even go to 0. They're just not going to help my overall returns. But like that 1 in 10 might deliver such returns, a bit like your 10x's here. Like I'm looking with that sub portfolio, I'm looking for like 100 times returns, right? And you find that one in a blue moon, and that covers the losses of all the rest, and it really pays you off big time. And so this is a legitimate strategy, but the bit, and I know you know I was going to lay into you, because in our Monday dashboard, you will see my comment. Your odds of 10x column hints at mental illness, buddy. What are you smoking that you think? Let's just take one that we talk about over and over. CHRS Biosciences, right? And I'm supportive of that. I now have like CHRS options. I want them to win. There is no way on earth that 75% of the time in the next 2 years they're going to 10x. 70. I get that they could. That ain't like a 3/4 of the time.
Okay, I think you're misunderstanding, or maybe let's nuance what my 75% means.
Okay.
Because, or maybe we are saying the same thing, but we'll just arrive at different conclusions. I know the fundamentals of CHRS inside and out. And it's not me saying that this is, say, a random biotech that is, say, pre-FDA, in that the odds are just 75% in their favor, because that would be the kind of like at best I should probably say like 50-50, or whatever. I don't even know what the stats are between FDA approved drugs or not. I could look that up. So you would be right if that were the case, if this was, say, any biotech. But remember, with Coherus, this is pure commercial execution, which is their great strength. And now we have 2 quarters of data already in hand that tell us the execution of commercialization is going along better than expected. So why did the stock drop so badly? Because another black cat crossed their paths and they had this manufacturing labeling stupid issue, which they recently said is now resolved and it's now back to the ramping process. Most people, right, on Wall Street, all the analysts don't know anything about that. The algorithm saw like a massive decline in price and the share price got as low as 70 cents just a month ago as I was loading up, right? As I was loading up on these shares down to 70 cents. Today, interestingly, it's up another 21%. So right now it's at $1.32. So I'm almost at 100% gain in just a month because the fundamentals are, what they are. And eventually this, what looks like a gambling position really is not. So I put 75% because it kind of really felt to me like the same in poker. I'm holding aces, knowing what I know, I could still lose, but it's like the reason I would lose would be mostly bad luck, which again could happen, right? But I wasn't going to lose because of, say, the unknown of FDA approval. That's already in the past. And more to your point, Badger, Coherus could go from, this is the other point, the valuation, right? At what point are we starting? So Coherus got down to, I think it was $80 million valuation, 80 million. Based on the basic math of how much of their drug is needed and how much they're making, that valuation could easily be 800 million. That's the 10x.
Yeah, don't doubt it.
Right?
Yeah.
From that price, just on those drugs. Forget any of their pipeline drugs that are really promising. I'm not even adding any of that, because if I added that, this could be a 20x, a 30x, because then, then the numbers get really silly. But forget all that. This is basic, like, can they execute? And so, with the poker thing, maybe not aces. Maybe we could throw in the debt convertible notes hanging over their head in 2026. But we'll know in 2025, if they execute, that's going to be fixed with cash and, refinancing, whatever. Wall Street's going to forgive that overhang because the fundamental business will appear so strong. So I was thinking, like I always do, like, what kind of hard cards are these? Maybe not aces. Maybe these are kings or queens. And so, that's still starting the hand with what, 70% odds? I don't know. What is the odds of, depending on how many people are at the table, right? I mean, all that, but.
Sure. Okay, you're getting a bit more grounded now. I think you're coming around to the idea that like 75% is not the right number there. No argument with what you said. And I'm not going to try and dispute the thesis with you. When you put this together, like my comment on mental illness was like a little bit jokey, but also like maybe a bit on the nose. And that's why you're kind of, you're bouncing around a bit and you've listeners, Christoph has to keep a towel on the desk because he's like, when I was doing the editing, he's like banging the desk where that comment's just like this. And it's a freaking pain in the ass to fix in the edit. They got all these like noises from the jungle and he's in Austin. So yeah, he's banging his towel right now, but you're probably sweating into that towel as well, right? Because like if you were realistic, like, okay, we just had a short conversation about it. I haven't pushed you on the thesis at all. I've just asked you to justify your odds of 10x. Like what should that really be?
Well, you know what? I'm going to stand my ground on Coherus.
Okay. All right.
I am. And I'm going, and it's not because, tell me if this is, it's not that if you repeat this experiment, it's not, I think you said something earlier about your like 3 out of 4 times this will come good. For some reason that feels off to me because it's not like about, there's something about it that feels like these kinds of situations, 3 out of 4 times success is too high, which I would agree with. It's that when you add all the things that I just mentioned together in this particular situation, not all situations, it's not a repeatable scenario. Given this data, it seems like the odds of success are way higher than 50-50. And so I picked 75 as a kind of random number signifying, again, what aces feel like.
Okay. All right. Fair enough. Fair enough. Yeah. And
So
it's a made up number, so it doesn't matter. It doesn't matter what you put there, but it does sort of hint at the way you think about the company. And like, I suppose if nothing else, right, I'm just being like an opposing voice because I don't want people listening to this podcast looking at this and going, oh, all in on CHRS, because those kind of actions, you might do really well, but they're much more likely to F you up.
Yeah. And actually the as poker players, we know the pain of losing with aces. And the problem with a great hand at the start is you could still and will lose your stack 20% of the time or whatever it is, right? So going all in, no matter how good your hand is, needs to be very carefully calibrated in terms of your larger risk profile and where you are in life and so on and so forth. So these kind of probabilities should really be taken with, as Badger is suggesting, a lot of other contextual pieces of data that only you know.
Yeah. Now, I think there is if you want to read more about this topic, and if you want to go out and look for like 10 baggers or 100 baggers of your own, right? There's an excellent book that's well worth a read by a guy called Chris Mayer called 100 Baggers, subtitle Stocks That Return 100 to 1 and How to Find Them. And I haven't read this for a couple of years, and I put it on the desk because I should probably reread it. But I remember a couple of years ago, I did a podcast episode with my buddy Albert where we talked about this book and we both read it, and we pulled out some notes on Chris's, the author's, attributes of 100 bagger that he found. I thought it might be worth just like recapping them. I haven't actually read my own notes for a couple of years. I'm just going to kind of read some stuff I pulled out here. Like, you're unlikely to find 100 bagger in like a mega cap, like Apple, Microsoft, Amazon, right? That's just a given. Like on your list, even Tesla is a bit of an outlier because it's $1 trillion market cap. Like, it's going to be hard to get to $10 trillion. Chris also observed that, now we're going to get a bit detailed, maybe I'll start with an easier one, like high margins. You'll typically find like your massive returns, your 100 baggers, your 10 baggers typically in companies that have a high gross margin. That's kind of like, you make, I don't know, bottles of vermouth, and then it costs you have to buy the raw materials and you have to buy like the stuff to make 1 unit of a bottle of vermouth. So the gross margin is like the amount of money. Say it costs me, like you bought this for me, I think it was like £30, very kind, it's a good bottle of vermouth, thank you. And maybe it costs
more than that.
Yeah.
It was more than that. You're not a cheap bet.
Maybe it costs the manufacturer, like booze is probably cheap, but there's like tax and other stuff. Actually, no, it's not tax. It's like the cost of manufacturing the thing. So like the gross margin on a bottle of vermouth, I got no idea. It might be like 50%. Maybe it costs them £15 to manufacture 1 unit. They sell it for £30. That's the gross margin is 50% gross margin. Like companies that have a high gross margin, that hang on to more of the money that they generate from selling products or services, that's typically like good hunting ground for like mega return opportunities.
In fact, Badger, may I interject just for 1 second? Yeah. The company that I know the least at this moment, just because it's so new to me, AST Space Mobile, one of my new King of the Jungle companies that I highlight on this new fancy spreadsheet. The real reason that this is a case study in that, in my initial research, it seems like their gross margins might be somewhere around 90%, because really the thesis is that once the satellites are up, the kind of call it majority of the CapEx is done, then it's a flip of the switch and then instant revenue generation from the revenue splitting between the cell phone providers and AST Space Mobile. So that's exactly why. Though I only gave the odds of the 10x to ASTS at 35%. Only 35% because I still don't really know enough. Though it's another one of these cultish stocks that there's a lot of talk about this company, and there's some wild price projections on the interweb. So who knows?
And let's pick up a couple of other Chris's criteria. So typically good hunting grounds are companies that reinvest in themselves. So they take like free cash flow. It's like the money left over when you've made your bottles of vermouth and sold them, and you've done everything to operate it. You've like built your factories, and you've paid all your research guys who are like tasting new different varieties, or all the stuff you need to run the business. You've got money left over. The board can decide what to do with it. If companies typically reinvest it in themselves, maybe by doing like share buybacks, things like that, then that typically gets the compounding engine, like the flywheel, spinning even faster. And that tends to be something that companies that deliver like 100 times return tend to do, so they can accelerate growth.
Apple right now is a good example, right?
Yeah.
Just off the cuff.
Yeah.
So much cash, just buying back massive amounts of shares. This was one of our former 7 investing colleagues, kind of one of his, Matt Cochran's bread and butter, like share buybacks and capital allocation as a strength.
Yeah, and actually, you gave Matt a shout out there, like good one. We are hoping to chat to Matt on a future episode of the podcast. So if you're a fan, like hang around, we'll have him on hopefully on the run up to Christmas. What other criteria does Chris pick on? Like valuation, maybe coming back to our conversation at the start around NVIDIA. Like you really want a company with like a lower valuation multiple, like the growth isn't priced in yet. And so, that is certainly the case with some of your beaten down companies like EOS and CHRS. Like there's not a lot of expectations built into their share price. And so that's the kind of thing you should be looking forward to. And then the last item that Chris pulls out is return on equity, which is, I don't want to go too deep on this. It's a little more of a complex concept, but essentially it's like a ratio of net income, which is like the money the company has left over after doing a bit like free cash flow, slightly different, divided by shareholder equity. And there's too many complex stuff to really explain that one. But essentially, it's kind of like a measure of business efficiency. You can't use it for every kind of industry, every kind of company, but return on equity can tell you a little bit about the way the company is operated. Yeah. So anyway, some of it.
Yeah, a lemonade stand example might work. Like if you go around trying to start up a lemonade stand and you go to each neighbor's door and everyone gives you only $1, right? Then let's say you have $10 in your pocket, you could buy only some amount of lemons, right? And so you're sort of, we know lemons aren't a great business, right? No one's going to pay $1,000 for your cup of lemonade. But if somehow, I don't know, in this example, everyone happened to give you, same amount of money, but all of a sudden drinking lemonade cured cancer, then with the same amount of lemons, your business could potentially be worth a lot more because that initial equity could stretch a lot further.
Yeah.
So, but most things remain rational. So you can't do that much with $10 of lemons. So that is really going to put a limit.
Yeah. And you can't use that like robotically for every kind of company. Like some kind of companies need a ton of stuff to operate, like massive factories and things like that. Or they need, not just lemons, they need like 2,000 different bits of highly specialized equipment to produce like one glass of lemonade. And so your return on equity could look really ugly because you've got all this capex sitting around. But it doesn't necessarily mean it's a bad company. It's just a sector where that measure, you have to think about it in a different way, generally in relation to other similar companies. You can't just kind of use something like ROIC or ROE and look across like lots of different industries and then say, oh, these are better and these are worse. Anyway, it's probably beyond the scope of the kind of conversation we're trying to have. But essentially, I suppose I'm going to promote the book, 100 Baggers. Like if this topic interests you and you want to know more, like go buy Chris's book and check it out. It's a good read.
Yeah, and I think this is a great moment to reflect on our journey so far. That it's what I said at the beginning. It's amazing to me that a year into our show, you and I have followed very opposite. Not opposite. It's just that our investing paths have taken this interesting, almost like divergence, but there's a lot of merit to both, but they feel very different. And so And there's a time and place for each, and you could do different combinations of both. And so I think that Badger's suggestion that our listeners check out that book is very good. And I really highly would love it, or I encourage everyone, if our Patreons were to check out this little portfolio that I made about my 10Xs and the commentary I made, and post some questions or comments or feedback or blind spots or anything like that. Because if I'm right about any of these, there is serious money to be made. And it's kind of shocking to me in this moment that I think I'm right about most of them. So time will tell. But yeah, I'm not out, I'm not yet in the market for any yachts quite yet. But, that wouldn't be a bad fate for us to float around, record some Wall Street wildlife from, a yacht in the Mediterranean one of these days.
Well, maybe I would be able to fund that if my Rocket Lab investment continues to go orbital the way it has been for like the last year or so. I was happy to say I wasn't in this company early, but I think I've been buying nice and steadily when it's been in the pits with a peak pessimism, and suddenly this one has caught fire. I'm going to pop something up on screen because I kind of want your, I don't know, I either want a hug or I want like a kick in the ass. I don't know which I'm looking for here. But so here's a chart which shows where and when I've bought Rocket Lab. And you can see I've bought it 5 times down in the kind of $4 or so. And well, like just before we started recording today, it was like nearly $26. And it's given some of that back from the pre-market. I just want to pick on a couple of my comments because I do think this is interesting. Like I always, well, we both always advocate having a process and then having a way of improving your process. And so like a key thing in that is like you need the data. So whenever I buy or sell anything in my main stock portfolio, I just write like at least a one-liner, sometimes more, just to say, what was I thinking? And then back in February this year, I bought some stock, like I added to my position, and I said, the company has just issued convertible debt. The stock has crumbled, happy to add this high conviction long-term holding. And then I added again in May at $3.88. Decent results. Stock is down 5% as revenue is a slight miss and Neutron delayed. Happy to keep nibbling into strength. Well, like I just bought this one slow and steady, even actually adding just like 2 months ago, part of moving some money around the portfolio. Like this has come out of nowhere for me, and it's now like materially my second biggest position, and it's in danger of becoming my biggest position. And like my biggest position has always been Intuitive Surgical pretty much from day one. And it's taken me like over 20 years to build up like the real dollar number that has turned into. And it's, it's a chunk of change. And now Rocket Lab is like chasing its heels and might be my biggest stock position, like out of nowhere. So yeah, like I feel like I'm going to have to trim this at some point, but at the same time, I don't want to interrupt compounding because like Netflix delivered life-changing returns to me. Then Shopify took over and then ran with like the baton in the relay race. And now Shopify has handed off the baton to Rocket Lab in my portfolio, at least. And, I don't want to be waylaying that stock on the way to the finish line, because this is how we get to like recording episodes on yachts, right?
Oh, I can't wait for that. I think I have good. So are you inviting me to give you like personalized non-advice?
Yeah. I won't see you. Tell me anything.
Yeah. So this is one of those cases where I know you and I know your life situation and I have more data to work with. So a couple of things to remind you and us both. For example, I could just do this from memory. I don't need to pull up the chart, but it wasn't too long ago when Netflix plummeted severely for whatever reason it was. Who knows? Doesn't matter. Likewise, Shopify, right? Yeah. So no matter what, any company, especially if it's still, it's not in that capital allocation stage where they have more money than they know what to do with, safety stage, that anything could happen. Confession, I sold my Rocket Lab shares in my real world portfolio again right at the stupid, like right before the hockey stick trajectory, because I needed to find more cash to add to CHRS.
Sure.
So net, I'm still doing fine because CHRS is now, making up the difference. You don't need all your stocks to win, etc. That's besides the point. But of course, I have an egg on my face for selling Rocket Lab. Again, besides the point. Given, I think, Badger, where you are in your investing journey in terms of like what you need your gains to be, don't forget that Rocket Lab is still a baby. Rocketry is explosive. What can go wrong at some point, what can go wrong will probably go wrong. And I would feel really bad for you if we're this close to a yacht, right? But the reason we're not on a yacht is because this position got to something like 12% or, something really, really big because of the hype phase. Why not? Knowing you already have enough, right? Knowing that it's now more about risk management as a heavier thing to think about, why not kind of call this like already a kind of victory and take some of that risk off to more of the defensive positions, the sleep well quotient at night? Because if I were to argue your position for keeping it at number one, it would be start getting close to my greatest investing mistake, which is I wanted more. I call it greed. The greed, like, oh man, I'm really good at this and I'm winning so hard. Why not, get to whatever, and greed usually doesn't work out.
Yeah, that's actually that's a really interesting comment. I didn't put this on the docket because I don't want to be like braggy with it, but I think there's like something here that is also in the back of my mind. Like frankly, right now, I feel like an absolute investing genius, right? But probably everybody does because stocks are like wildly high right now. My CAGR, like my compound annual growth rate, for years, it was like 26%, which is kind of ridiculously high for like 20 years almost, 18 years. And then post-COVID pandemic, and I took a battering and I wiped out like 42% of my portfolio just after I retired. I've told this story before. In 2022, took a long time to get back. I'm now back above that point. Like I'm now at a new all-time high. And like every day I'm at a new all-time high. And my CAGR went down to like 19% because I took such a hammering. Like 19% is still like world-class results. But relative to my performance up till then, like I suddenly got smashed. And I remember back then thinking like I'm a genius. And now I'm kind of feeling like that again. So I'm like, this is hubris, right? And now it hasn't tipped into doom yet. So I've got a chance to, like, as you say, take some money off the table, give myself a slap and say, you're not a genius. This is just investing, right? Long-term investing. You're going to have periods in the cycle when you literally can't make a wrong decision. Everything is just going well. Every stock you have is going through the roof. And then there are going to be periods in the cycle when like the ass falling out of everything. Your fantastic companies are still performing, but the stocks are in the bottom of the barrel and you feel like, like everything is going wrong and you can't, how do I turn this around? Like here I am now saying I probably need to get ahead of the ass falling out.
In fact, another confession for maybe some of our new listeners, if you don't know this, I'm but a humble educator. I work as a university professor. I was a high school teacher out of college, graduate student for most of my 20s, right? So I've never had a fancy corporate job where I was making bank, but I still, via my investing skills, could have retired had I taken money off the table in 2021. Right. But it's exactly this point. When things are going up, monkeys monkey's head got way too big, and I was like, oh, obviously this is going to keep going up because it is, and I'm such a genius. This is exactly the moment, right? We now know, both of us know, that we're not, and it's probably one of the best times to just lower the risk profile. And if I could not advise you one more time, you know what I would do? I would take whatever, cut that Rocket Lab position by whatever. You'll decide the right amount, call it whatever that is, and invest, spread it equally in all of Monkey's 10x positions. That way, we'd have a fleet of yachts. A fleet of yachts. We'd take over the whole Med3 in Badger.
Okay. Yeah, you're right. I will do that. I'm not going to do it just yet. So what I've put, like, I'm trying to bring also like an element of not being too market timery, and like, it's not my biggest position yet. Intuitive is still my biggest position by a good margin. So like, it's like 16% allocation versus 10%. So I think if this gets to like a 12% allocation, I'll probably trim it. And because it's not because I don't believe in it, just because it's a tiny little company and like stuff can go wrong, things go boom. And they're flipping into their Neutron program in 2025. We don't have a date for the first launch yet, but I'm definitely going to take some money off the table just before that, because like, much as I hope Neutron's going to be seamless, like, it's a big complex inflection for the company that's going to cost them a ton of money, especially if things go wrong. They've got a ton of money to pay for it. Like, I think they're in a good place, but you just got to manage risk. Now, I will say as a caveat as well, that I'm not going to not name and shame, name and like celebrate. I've got an investing WhatsApp group with a bunch of very close friends. And I sort of persuaded them all to buy Rocket Lab stock like a week ago, 2 weeks ago. And we've now amended. It used to be, the WhatsApp group was Investing Family. It's now Investing Family Rocket Ship Emoji. And now they all own, even the ones that don't really buy it, they've all bought like an entertainment stake in Rocket Lab. So we all own a Rocket Lab now. And I said to them a couple of weeks ago, like, even though I'm sitting on like a 5 times return now from like the lows, like, this stock still has a ton of value built into it. And awesome, right? 2 weeks, the guys are all up like 20, 30% almost. So it's going well. Rocket Ship Emoji is going well. I am going to take some money off the table, but that's not because I don't believe in the company. It's portfolio management. And you'll see that because I'm going to post that on Twitter, because I'm transparent every month or every 6 to 8 weeks. And I post like what I've done and why, like, I'm going to have to start trimming this one, but that's personal reasons. And that's exactly why you can't just copy another investor. You got to understand, and you got to take the actions that are right for you.
Yeah, brilliant. I hope to ask you the same exact question in maybe a year's time. And this is a preview for an interview that we already talked about, but we're hoping to have a special guest to talk to us about Chainlink, which is my number one position in the investing world. I'm begging all of you listening to this to go and just type in Chainlink Labs, go to their official site and just start poking around. And I hope that, call it in a year's time, Badger, I'll come to you with the same exact question saying, oh my God, I'm up, 1,000%. And do I sell now? Or, and you'll be able to provide me with the same kind of, I feel like a genius. What do I do?
Look forward to it. And look forward to that interview. The guy you've teed up to chat to us looks like an interesting fella.
Indeed.
All right. But you think these stocks are great. Shall I tell you about the greatest investment opportunity that the whole of the Twitter sphere can offer you right now?
Yes. What is it?
Have you heard of a startup called Dognosis?
No, but I like dogs.
You do like dogs. You are not going to like this company.
Oh, no.
Like our furry friend. I kind of like the idea, but it's just such a dumb idea. Come on, let's face it. And you see a ton of this when you look at private investments. You just see stuff that you're like, no, sorry guys, that ain't going to work out. And like, the story here is you know what dogs are, and like, there are stories and there's evidence that like our furry friends do have such incredible olfactory, like, sniffing systems that they can detect like diseases in humans, like cancer, for example. Like, dogs can sniff out cancer and impending doom. And I think that's legit. I haven't looked at the science. I think that is legit. And then you might also have heard of brain-computer interfaces. And there's like some great like steps being taken by one of Musk's companies, Neuralink. But like Neuralink is literally putting like actual like electrodes into the brain, tens of thousands of them. And then there are individuals today who can control their computer pretty effectively, move the mouse, click buttons, literally just think by thinking. So that's like incredible real progress. Brain-computer interfaces are real. There are much lower resolution versions of brain-computer interfaces, which are literally like a skull cap you stick on the outside of your head. And then using AI, they try and read something about your train of thought. There's not enough resolution there for me to ever believe that's going to deliver, at least with current technology, next 10 years, anything like being able to control a computer and move a mouse and click a button. Well, anyway, these Dognosis guys have put these two things together, and they're now outfitting their pet dogs with brain-computer interfaces, like a hat on the head. And then they're using the feedback from the dogs sniffing cancer patients, I think, to sniff out disease. And then they're going to build a bunch of models around this and have like Cyborg-Dogs sniffing out cancer. What do you reckon?
Wow, I'm just, as you were talking, I went to the website and I'm looking at some of these pictures, and I reckon you assumed I wasn't going to like it because, it's putting funny hats on, these beautiful creatures. But on the other hand, as you were explaining it more deeply, Badger, when I go on my morning runs in the neighborhood, there's a blind man who is always led by his dog. And it just melts my heart each and every time, like that true symbiotic love that happens between man and companion. And I don't know, I'm not as opposed to this as maybe you thought I would be, because there's something like, dogs are such pure love that maybe after they get past the funny hat, like if they could save the lives of their masters and humanity, that they would be all for it. And it's kind of like they get to be even more altruistic than before.
All right. Oh, it's not going in my portfolio, I can tell you. But if you want to get your venture investing journey started, you got the website now.
So you said this is another one of these private companies?
It is, yes. Yeah, I literally, this one I just saw on Twitter because I trawl regularly for companies raising in the private sphere. Yeah.
Okay. All right. You wanted to talk about penny stocks?
Oh yeah, I did. Okay. These are things.
This is right up my alley too.
Okay, good. All right, good. Right. Penny stocks are dangerous. There's a reason this is on the docket, because one of my friends I played tennis with mentioned that she lost some money in penny stocks recently, I think. And then she was distraught because like she got wiped out. I don't know the details. And then like the penny stock went on to like double or triple. And she's like, oh, I've missed out on these gains. Like, this is just not an area you want to be investing in. Right. Full stop. It's very hard to argue. Right. In an incredibly special situation, this is just right. Typically, okay, first of all, what do we mean by a penny stock? Right. Start there. So, like, if
can I take a swing at
this?
Yes,
please. Yeah.
Actually, because I'm gonna offer the counter argument to this, but it's sophisticated. Let's start with the basics. I think technically, Badger, the definition of a penny stock is any stock on the market that is trading for less than $1.
Yeah, like in that range, like up to maybe a couple of bucks. Like it's a bit of hate.
No. Because actually, curiously, because I've gone through this personally, there's a ticking clock on the market that says if your stock trades below $1 for, I think it's 30 days or some whatever period of time, then it's at risk for delisting, and a bunch of regulatory clocks start ticking. So then it needs to end a day's close above $1 to reset the clock. So $1 is for sure the cutoff.
Okay, fair enough. Yeah, and it's literally as simple as that, right? It's the stock price, and like there's something instructive. Well, maybe like this is alluring. Like, why is it alluring to invest in penny stocks? And like, if you want to learn about what penny stocks, just go and watch like The Wolf of Wall Street, right? Because the whole shtick was like this guy making bank by selling like literal shitcos. This isn't like diversified dog shit we were talking about last week. This is literally like garbage that's worth nothing. And this, I forget the name of the character, but you know, the Wolf of Wall Street basically made his money selling shit to schmucks and making like a massive margin. Like the broker was making more money on the trade than actually was being invested. But
the only regret you'll have is that you didn't buy more, Badger.
That's right. Yeah. And it is alluring, right? Like, and the sort of logic kind of adds up in a dumb way because, you know, I could say to you, I'm trying to like shill this like absolute garbage stock. And I'm like, it's trading for like 50 cents, right? And it's alluring because I could say it only has to go up by 50 cents and you've doubled your money. And you're like, oh yeah, that's right. Right. That's like, it's the same as saying, you know, a company like NVIDIA is at $3 trillion. It only needs to go up by $3 trillion more and you've doubled your money. So, I mean, these are completely different things, but it's kind of the same thing, right? Any company, this is not a useful direction to go in, but maybe a more useful place to go is like they're alluring, but why are they dangerous? That's probably the meat of the conversation we should be having. And maybe to start us off on that, we should think about how a company became a penny stock. I think that might be an interesting way in because the share price, frankly, is just irrelevant. It's not a meaningful number. If you want to relate to something that's meaningful, it's like the market cap. The market cap is the share price times the number of shares in issue. And it's like there's like enterprise value and there's other ways of talking about it. But essentially, simplistically, the market cap is like the value of the company. Tesla is worth, in theory, $1 trillion because that's what people are willing to pay for it. And the share price could be anything. Like if companies do like stock splits, and for company, like if Tesla did a 10-to-1 stock split, which they have done in the past, then I don't know what the share price is today, like say $250 or whatever it is. If they did a 10-for-1 stock split, nothing really changed. It's just like they took this pie and they chopped it up into, like they chopped every slice into 10 extra slices. So the share price would go down from $250 to $25, but there'd be 10 times more shares. Nothing has really changed. It's like an accounting thing. And for some like weird reason, shares tend to go up when they do a stock split because then the old story was, well, it makes it more accessible to an investor, but that's not important anymore. Like it's hard to buy a Mercado Libre share because they're like $2,000 for one share. And so I struggled to build a position like way ago, but today you can do fractional trading. You can buy 1/10 of a share at 100th of a share. So like it is completely meaningless. And so when companies list, typically, like no company is really realistically, if it plans to go public, it's not going to list publicly with like a sub $1 share price because that sends a very, very bad signal to the market. So companies typically have sub $1 share prices because they've fallen apart, like they've fallen off a cliff. They might have had a $10, $20, $1,000 share price once, but they've underperformed so badly, their share price is now worth less than $1. So this is, you know, I mock the technical trading stuff, but like what you say is true. The fundamental truth is like you're looking for stuff that's increasing in value, like the line's going up, not going down. Well, all of these companies that have $1 share price or below, like they're somewhere along that long journey down into the dumps.
So Badger, if I may, I think there are two interestingly separate arguments here. So let's slow down a little bit. Let me add to the penny stock, what are we calling penny stock definition first. In my investing life, I've always thought of it from the direction of there's a bunch of junk out there, and that junk is usually closer to like 2 cents, 3 cents, like almost literal junk. You could, it looks like junk, it smells like junk, it's priced like junk, it has some weird name, like, you know, and people still fall for that, i.e. Wolf of Wall Street. Yep. That's what I would call, to me, penny stocks. My own experience with both CHRS and EOSE are actually a little bit of a rebuttal to what you said, even though most of what you said is still right. it's not good if your stock ends up in penny land, because that means that it's somehow underperformed.
Yep.
But in my King of the Jungle portfolio, I bought EOS at under $1 a bunch of times. And I was trying to add to CHRS as much as I could under $1. The recent buys were at 77 cents because I did my fundamental research, and these companies CHRS was once a multi-billion-dollar company, and I could explain to you rationally, logistically, what went wrong and why I think it's going to reverse. So the fact that it was technically a penny stock is way different than me going out there, finding a penny stock, crossing my fingers, and gambling.
Totally agree. Right, context is vital, and I think, and so you've ended up in Pennyland because you think you found like this deep value, essentially, right. Something that shouldn't be worth sub $1, but it currently is. So like it's on massive sale, in your opinion. The thing is, though, like, and this is no implication about my friend from tennis. I've got no idea how much. Maybe she does a ton of research, but I think your typical investor looking at penny stock land is like buying stuff because they're penny stocks, not for any other reason. They're just like, oh, you know, here's just gamble on these like things worth 10 and 15 cents. And like that way, it just leads to doom. You would be much better off going to the casino and sticking your money on like a couple of numbers on the roulette wheel, because you're going to get much better odds of roulette than you are like in this world.
Yeah, same thing with people buying lottery tickets. It always makes me so sad because you are not going to win. But actually, anyone listening to this, like really, really get your Q-tips, open up your ears, because this is a habit. Like even my mama, hi mom, I know you listen. It breaks my heart every time I see someone buying a lottery ticket for 2 reasons. They're not going to win.
Well,
Actually, 3 reasons. They're not going to win. Philosophically, if they do win, they're not going to be any happier. That's a whole different philosophical conversation, but odds are they will become more miserable rather than happy. But the third most pressing reason, Badger, is because any amount of money you spent on lottery tickets could have been used instead to buy shares of Rocket Lab or CHRS or Chainlink. And not only did you not burn the money and turn it into zero, you could have actually start developing your habit of investing in the principled way, which will actually get you rich.
Yeah.
That isn't magic hocus pocus. So it's like heartbreaking in all these ways. So maybe some of you could comment on our Patreon page about your own experience with lotteries, and whether what I'm saying, what we're saying, maybe changed your mind or not.
Yeah. I've in like Luke's version of hell, like the very deepest, like Dante's 7th level of Luke's hell are like the money lenders and like, you know, the companies that exploit, you know, the financially unaware. Like in the UK, there used to be a company called Wonga. They used to just like, you know, like have 50,000% APRs on like payday loans. I'm sure there's plenty of American companies that do the same thing. Like, screw those guys. But somewhere in those levels of hell, I think, are like lottery organizers, including like nationally managed ones. You know, I sit on the board of a charity. We're the beneficiary of like a bunch of lottery funds. But so maybe, you know, there's many sides to some of this stuff. But
yeah. I mean, what we're both saying is like human desire to get rich quick, to which we're all susceptible. Yeah. Our institutions take advantage of that. And in the stock market, that is called penny stocks in the classical tradition.
Yep.
Don't do it.
Yeah.
Don't do it.
If you do it, recognize your gambling and recognize that you could easily find much better gambles than like living in this world. Right. If you want entertainment, like find it somewhere better. Yeah.
Speaking of, I think that's a brilliant segue, Badger, to our next segment, which, and if you're watching this on YouTube, I'm about to take off my monkey hat and put on my dodo hat. Look at that. Look at that.
It's a dodo. Do you have a phoenix hat? We're doing a phoenix or dodo session. Do you have a phoenix hat as well, or is it just a dodo?
I do.
Oh.
Haven't you seen it?
Have I?
It's sparkly and red.
Yeah,
Yes.
right, okay, well, okay. We're definitely the dodo today.
Yeah, the dodo is unfortunately a fine bird that went extinct, just like a stock that has, as we're recording this on Monday, November the 25th, looks to be heading in the same directions, and that is Cassava Sciences, ticker symbol SAVA. And this is actually really sad because they were promising a cure for Alzheimer's. And, you know, that disease is maybe one of the most awful diseases that humans have not yet really figured out. And the intrigue here was that the data looked really promising until it became clear that I don't know if it was the head scientist or one of the head scientists was basically fudging the data, or there was some potential fraud in the data.
Right.
And so this is a stock that was talked about a lot at our former place of employment, 7 Investing, where there was a lot of, arguments back and forth, because I think people were we want to hope, when we're in the face of such awfulness, we really want to hope that there's going to be a cure out there. And so people were willing to, I think, overlook the accusations of fraud. But to me, this is very similar to any whiff of accounting fraud. If it's even like plausible that one of the chief scientists did something unethical, you cannot put any real money on that and also not think you're legitimately gambling. And today, basically, the company reported that their data ain't gonna cut it. I mean, that's the long and short of it. And as far as last time I checked, the stock was down 90%. And given their cash position, it's game over. It's going to zero. I was actually thinking of still buying puts because it's still like at $4. It's still worth whatever. So that's, I might do that after we finish recording the show. I want to shout out to 7 Investing user Findle, who is somebody that I've gotten to know on the chat boards, both at 7 Investing and over at SaltDB. He's just a really thoughtful investor and works in healthcare. And he made a list of 7 lessons from this particular situation. And I'm just going to read them as he posted them this morning. 1, as long as it's safe, the FDA will not block phase 3 trials. So if the FDA is blocking your drugs, your company's drugs, it's probably because there are issues. 2, hiring people is not a sign of a drug's upcoming success. That was one of the bull theses for why would they be hiring, right, if the data is fraudulent. So it's false causation, fallacy of false causality. 3, data based on fraud is not real data. That was my main point. All I needed was this number 3. If there's even a whiff of fraud, don't go near it. 4, data based on anecdotal evidence from people desperate for hope is not data. 5, if the scientific community is challenging the fundamental mechanism of action for a drug, avoid it. So this is where people with a deeper scientific understanding were saying, we hope this is true, but it's not. So it's not how things work with Alzheimer's. 6, be skeptical of an investment thesis based on total addressable market. You and I have talked a lot about this. You have to really know for real, right, what an investment might be worth in the best case scenario. But that's what propagandists for stock will start with. Oh, it could be $200 billion if blah, 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 blah. I'm guilty of this sometimes myself because it is exciting to think, right? I think this is maybe the least problematic of these red flags, but still. 7, do not try to interpret research practices like Western blot analysis without personal domain experience. And this goes back to the fundamental point. If you invest in something like biotech, you really have to hitch your horse to people in the community that know that stuff inside and out. Otherwise, you're gambling. And it's really sad this morning. I bet a lot of people lost a tremendous amount of money. And the fact that we're no closer to a cure for Alzheimer's via this vehicle is triply sad. And the writing was all on the wall. And it's going to happen again. And it's just, man, I'm bummed that this is the outcome. But professionals looking at this saw it from a mile away. That's
a shame. Yep. Agreed. Good lessons there. Well, I'll check that Findle's cool, and we'll stick a screen grab of his quote on the podcast today.
Yeah, good job. Thanks for that summary, Findle.
Well, so that's a really sad story about that stock SAVA. So hopefully not too many listeners of the show were over-invested in that one. And it just shows, right? Like biotech is highly volatile. Like stuff can literally deliver 10x returns and it can literally go to zero, as you've implied this one might be doing. And if you were a shareholder yesterday, you're down nearly 90% today. So not pretty at all. But that is the way of investing. Yeah, which is why you should be diversified. Probably all these lessons in this one episode, we could bring them all together somehow. I do want to promote a conversation we are going to have in the next couple of weeks. We're coming up to Christmas. I actually did all my Christmas shopping this morning, all done. Mr. Bloody on top of it. Yeah.
What'd you get me?
Yeah. You gotta win if you want to get a gift out of me. You're not gonna win. But come up to Christmas and
because there is a very specific yacht I had my eye on. So I just don't want you to surprise me, like go through all your trouble and just get, one that's like that was close to, so just
I'll bear that in mind. To be clear, I am a long, long way from ever. Well, I'm never going to buy a yacht because it's just ridiculous. But I'm a long, long way from to rent a yacht. So don't worry about that. But anyway, like your kids, if you have kids or if your friends have kids, right, they're going to get like some money for Christmas, presumably, like a little bit of pocket money. And we want to help you as parents think about how you can help your kids grow that money. So we're going to do an episode focused on investing for your kids sometime in December. We're just kicking the details of it around. So anyway, if you have friends who have kids, or if you have kids, like subscribe to the show and get ready, because sometime in December we're going to drop that one and help you with your New Year resolutions.
This is huge. Anyone listening to this, please take us seriously. This is and tune in. These are life-changing habits and results that we're begging you to take into consideration. So I can't wait to record this episode because we know it will change lives. I mean, it's one of your best ideas ever. So
thanks. Very good. All right. Let's wrap it up for another week, Christoph. If you do want to chat to us, like go find us at the Patreon. Christoph keeps saying like the whole patreon.com/Wall Street Wildlife. Actually, like our own website, wallstreetwildlife.com, points right there at the Patreon. It's now our homepage. That's like where we do all of our deep thinking and chatting and community nonsense. So go find us there. But if you want to chat to us a bit more publicly without joining the sloth tip jar, you can find us on the Twitters, the X's. I am at 7Luke Hallard.
I'm at 7 Flying Platypus. And we also have a YouTube channel, obviously, where we like engaging with folks. I think I'm personally going to start spending a lot more of my effort on Patreon. So because it's just intimate and it's protected, and it's like people who say we're in your tribe, and it's, as opposed to public riffraff. And check out our Patreon page.
Great stuff. Are you ready to become a beast of an investor?
Your journey starts right here.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged to consult a financial or tax professional.